Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 29th, 2016. In this video, I wanted to talk about one of my favorite indicators to use to help gauge the future market direction, and that would be some of the various sentiment measures. Now, before we get into each one of those, I'll talk on at least two here. If there's time permitting, I'll talk on the third, time permitting at the end of the video. I want to keep this one relatively brief. But the three main sentiment indicators that I use are the put to call ratio, which we're looking at here, and I'll expand on that in a second. I like to use short interest as a sentiment indicator. When short interest is at an extreme high or extreme low, for example, when you're at an extreme low, it means the majority of traders are bullish. There are not a lot of shorts in the market at that point in time because the masses think stocks are going higher. Likewise, when short interest is very high, you have a lot of people shorting at that point in time. Therefore, the market has most likely already been going down. You have too many bears, and as you know, there's some dynamics that go into that. I can't get into details on all of this, but for the most part, when you have a very high short interest, you have a guaranteed supply of buyers in the market, because anybody that shorts a stock must at some point in time cover that short position. That means they have to buy the stock, buy to cover your position. And likewise, when short interest is at extreme lows, you don't have a lot of shorts in the market, which are those, the natural buyers of stocks, or forced buyers, I should say, not natural buyers. They're the only ones that have to buy. You might be bullish on the market, or you might trade long only, but you don't ever have to buy a stock. You may decide to just step aside from the market. So what happens is when with high short interest, the shorts tend to cover on the dips, and they can also fuel short covering rallies. However, when short interest is low and you have a stock market correction, especially a frothy market like we're in right now, market starts to fall, you don't have those shorts coming in to take profits, book profits, and cover. In fact, since the shorts, those that are more apt to shorting stocks, like myself, I love to trade stocks long and short, they may want to, at that point in time, engage the market short. So it will exacerbate any selling when the market gets frothy, because they're already on the sidelines, so to speak, and they can jump in at that point because they're not already committed short. So we'll get to the short interest at the end if I have time, but let's talk about the put to call ratio. And the other one that I didn't mention, we'll get to here in a second, are the sentiment surveys. I like short interest and put to call ratios. I probably would favor those two if I had to stick to one, because I like to use the term, when you're looking at the put to call ratio or short interest data, that's where people are putting their money where their mouth is. They're betting. If you have an extreme bullish readings, as we recently had here on the put to call ratio, anytime you see the put to call ratios drop down to low levels here, that means you have a much higher ratio of call buyers than put buyers, because everybody's bullish. The majority of people are bullish on the market. Conversely, when you get up here to these high levels, again, this is the put to call ratio, so a high reading shows you have a lot more put buying than call buying. That's when people are bearish, and that's when the market tends to bottom out on these high readings there. So we're going to get into this, as well as the sentiment surveys. And before I do that, I want to just go over 3 points that I like to mention with the using sentiment as a contrary indicator, because that's what it is. Again, when everybody's bullish, you have when the majority, I should say, of traders or investors are bullish, that means they're already committed. They've already taken the capital that they have, and they're invested in the market. So you essentially don't have a large pool of buyers, not many buyers left to buy stocks at that point. If everybody's long, who's going to buy stocks? Conversely, when sentiment is at extreme bearish levels, most or many traders and investors have capitulated, sold out of their stocks because they think the market's going down, and you only find those bearish readings after a prolonged drop. You'll never see extreme bearishness at a market high. That's about one guarantee I'll give you in investing and trading, is that the extreme bullish and bearish readings come at market tops or bottoms. So that's why they're good for contour indicators. So number one, they're not exact timing indicators. I'll get to this here. I'll show you some instances where it can take several weeks, even several months after these extreme readings with any of these, whether it's short interest, put to call ratios, or the sentiment surveys. So they're not exact timing indicators. Therefore, they're best to be used in conjunction with other technical analysis tools. So what I do is I'm on lookouts for periods of extreme, especially prolonged periods of extreme bearishness or bullishness. And I also want to say that I find sentiment surveys, any sentiment tools, whether it's put to call ratios, the surveys, short interest, I find them to be completely useless. In fact, they can be very misleading if you're trying to always extract some type of read or information from these. What I mean by that, to make my point, is I only find these useful when we're at extremes, such as here, extreme lows or extreme highs on any of those. Anything else in between is what I call no man's land, and I don't think you can extract any useful data when these unless these numbers are at extreme ends of their ranges. All right, and that takes time. So for the most of the time throughout history in the markets, you're not at extremes on these ranges. So these tools, you won't hear me talk about them a lot, and then all of a sudden, like today, I think this one warrants a video because I'm seeing some extremes across the board recently that certainly warrant monitoring right now. All right, so let's talk first on CP, the put to call ratio here, and then we'll move on to the other ones. All right, so what this chart shows you, it goes back to 2007. This was the market top here in 2007, where my cursor is. And shortly after the market top, we hit this reading. As you can see here, I've noted the largest corrections in recent years, which are these red arrows. You can see all the red arrows are the biggest corrections, biggest drops. This one hasn't happened yet. This is just my forecast, so we have a big one coming up. They've all come after the put to call ratio has reached this level. I have this blue line which comes in just above the 0.60 level, so about 0.62 or so. And you can see back in 2000, late 2007, almost right around the end of the year there, we had one of those extreme readings, and they're usually very fleeting. You have that an extreme plunge down to that 0.62 level or below. That occurred right here, as this blue arrow shows. It did come right after the market top. Market peaked back in October 2007 here. We had an initial leg down, and either it was in early 08 or late 07, we had the first counter trend rally in what proved to be a new bear market. Now, we weren't in a bear market yet because we hadn't fallen 20% off the highs. So what this was, just like what we may or may not be in right now, it was what happened there is you had a dip, bearishness ramped up a little bit, put to call ratio went up, then we had a rally, and the dip buyers stepped in. And at this point, they obviously thought the market was headed to new highs because they loaded up on calls. They didn't have an interest in buying puts. They loaded up on calls. I can assure you that some other sentiment surveys probably confirm that extreme bullishness. Again, when you dip down here, these are bullish readings, and boom, that was it. So we all know what happened in 2007, 2008, into the 2009 lows. That was one of the worst bear markets in history. Fast forward since March of 2009. This is the S&P 500, by the way, below. The S&P 500 has been in one of the most powerful bull markets in history, yet there have been some decent corrections. And again, all of the major corrections, as shown by these red arrows here, what they have in common is they were preceded by drops down to that level, and you don't see many of those. Now, if those drops come in close proximity, so right here we have, for example, 3 tags in relative close proximity. You can see the put-call ratio moving down, trending lower, and then you had 3 tags in relative close proximity, all indicated by these blue arrows. That's why I boxed it in here. I refer to that as a cluster of readings. And shortly after the last reading, very shortly after last reading, we had the biggest drop up until that point in time in this new bull market. Fast forward about a year or so later, we had just a single tag, and it went below that 0.62 level. And this one did it took a few months to materialize. You can see now the market, also note the market didn't go up a whole much. It went up a little bit from that point where the reading was. It was right around here, right at that peak in the market. So we went on to make a marginal new high. That arrow is a little deceptive because the high was right here. So I really should have, to do this over again, I somehow messed that one up. This red line, or that red dotted arrow, should begin from this point. I can't annotate the chart there. I can actually give you a screen draw tool, tell you what I'm talking about. So this was the peak right here, and it wasn't that much after the peak there. All right, but there was a lag time again. It was either, like I said, a few weeks to a few months typically on these. Fast forward, and we had this was the strongest run. This was a strong, nice uptrend that lasted for a couple years in the bull market, and we didn't visit this line again, this blue line. That one was close, but we didn't get there all the way until looks to be about right at the end of 2013. And then again, a few months later in 2014, we had a cluster. See two in relatively close proximity. You can see the put-call ratio trending lower there, and then finally trending back up. So this was a cluster of readings. And this one, again, it took a few months. You can see from looks about April to just before October. But then we did have a very, very sharp correction back then. Again, put-call ratio went higher, came back down, and now we had a reading of a cluster of 4 readings in very close proximity, either at or below that level. And again, that's that boxed area. You can see the market pretty much stalled out from the point of the first reading. You can see it kind of topped out there, traded sideways for a few months, and then boom, we had almost a mini crash there. Now, we never made it up above those highs right here. We peaked out before we even made it back to those highs. So this is why that red arrow shows that total correction. So that was the largest, if I'm not mistaken, it was close to this one, but one of, if not the largest correction that we've had in this bull market. So again, it was preceded by that cluster. What happened from there? Okay, everybody got bearish for a while, and then once again got very bullish. We had a reading, actually there's 2 readings back to back right here, I believe, next to each other, and then a third right over here. That was a cluster of readings. Now what's happened since then is, although the put-call ratio started moving back up, we haven't had a correction. We had a little blip down here leading into the elections, a little pre-election, I'm talking about the U.S. presidential election, pre-election jitters, but that is not a correction. That's just a little dip in the market. That doesn't even come close to any of these previous drops. So, and we're still only, a few months beyond that point of that last reading. And so my expectation, based on, again, historical factors, everything else in the chart, as I said, I use this in conjunction with other TA tools, negative divergences, market breadth, you name it. A lot of stuff is still pointing to a major correction in the foreseeable future here, and I still maintain, I know it seems like I've been saying this for months now, which I have, that the risk to reward remains skewed to the downside, meaning you're probably looking at the odds of the next 10% or greater move in the market being to the downside than to the upside. So just because this market hasn't cratered, it also hasn't gone very far. Yes, it's a new, not all. The NASDAQ hasn't made new highs yet. We've had a couple indices make marginal new highs, but we're really trading, if I'm not mistaken, it's something like 2% above where we were, almost 2 years ago, a year and a half ago. So this market's gone virtually nowhere. And I just want to point that out. This is what I'm pointing out here. This most recent cluster, and again, you can go back in time. You can even go back farther than that. I'm not sure how far this data on the CPC goes, but it's been a pretty accurate tool, and in forecasting some of the bigger corrections in the market. So we've had a couple of what have been historically very reliable signals fire. In recent months, yet we haven't had a correction yet. Okay, now that was a lot of time spent on the put to call ratio, and I think that's an important one. That's why I did that. Let's just quickly move on to the sentiment survey. Now I have on the front page of the site under Tools of the Trade, there is a link to the AAII sentiment survey, which I'm going to click on here. Just go to a different window. I already pulled this up. I watched this. Again, I glance at every now and then, but I don't pay it much attention when the readings are just, in the middle of the range. Even if they start getting up to the high or low end of the range, I still don't pay it much attention. It is extremes, such as we see here, right here. Last reported date was November 24th, so it's last week's readings. A very high reading of almost 50% of the traders or investors surveyed were bullish, 28 neutral, and only 22% bearish. So you can just glance it. Now, what I like to do is, and I'll show you what I did here. You can click, if I scroll down the page, oh, that didn't work. Okay, I had some annotations so the page wouldn't scroll. You can click here and download all the historical data since they've been doing this survey. It goes all the way back to 1987 now. I've already done that here. This is an Excel spreadsheet. Now what I did is I took the bull to bear spread. Okay, so it's one thing I just showed you that extreme high bullish reading, which you can see it down here, 49.89%. And the extremely low bear reading of 28.08% or 22.08%. Now what I like to focus on is the bull bear spread, because you can have a high bullish reading and you can also have a high bearish reading. That means you have a lot of traders short, even though a lot of traders are long, not many in the middle, and that doesn't really make for a good extreme reading in my opinion. I like to use the bull bear spread, as you can see here highlighted, bull bear spread. And what I've done with this spreadsheet is I simply clicked on that column and I had the spreadsheet highlight any reading when the spread was between 20 to 27% is highlighted here in yellow, and any readings 20% or higher, which there's very few. You can go all the way back to 1987. You're not going to see a lot. This is an extreme reading, and this is why I'm doing this video today. So here it is, a spread of almost 28%. That means a spread of bulls over bears by a margin of 28%, which is a big reading. All right, so we're going to go back. I'm going to show you this real quickly here. So the yellow, again, is the, let's call it a caution area. When you get it's not very common to see a spread of 20% or more. So that's why I colored those yellow. Here's a yellow reading. See, I'm going back in time. This is each week. We're going back 1 week at a time. And here's a cluster of readings. So we're gonna look at these readings. I just wanted to show you my methodology here, and now I'll jump over to the charts and show you what these readings look like, because I plotted them against the S&P 500. All right, here's the S&P 500. Now I did this going back, to keep this video relatively short, going back into late 2013. And again, that's all those readings on the spreadsheet I just showed you without any exceptions. Red is the readings over 27%, the bull to bear spread. Anything between 20 to 27% or just under 27% is yellow. So let's just start from the left to the right, because here we've had a cluster in the last two weeks here. So we go back to late 2013. Here's a little seasonality for you, because this is around the same time of the year. These occurred. I can tell you right now the readings are 1 day off, because they must report on, yeah, they do. They come out on a Thursday. I'm using a weekly chart here, the S&P 500, and that means every candlestick is 1 week's trading action. So those candlesticks are printed on Friday at the close, but close enough. So you have those, the AAI report coming out on a Thursday, and these readings are on the candles at least are on a Friday. So that's where I put these horizontal lines. So there it is, guys. You can see two clusters, and let's just look at price action. Let's not spend too much time on this. I think you guys can already see what's going on here. So you had an extreme bullishness, and that was right here. Here's the top at this point. Let's circle it. There's the top of that candle. On the red, on the second of the two readings, that cluster right there, the market really didn't go any higher. We had a couple intraday pierces, but if you put a line here, you could certainly do that. Market never went any higher, and then we had one of the biggest corrections in many months, if not years there. So there's a drop. Let's change that arrow color. Okay, I think that magenta color stands out a little better. Okay, so here was a little caution sign. This was again a reading between 20 and 27%. We did go a little bit higher for a few weeks. Again, remember these are weekly candlesticks. So for about 3 weeks we went up, but then we gave all those gains back and then some, followed by a nice correction. Here was a cluster of 3 readings. You have a yellow, a red, back to back. These are each candle 3 weeks in a row. Yellow, red, yellow. And that was it. That was the top right there. You can see that just a candlestick wick. That means intraday we went higher. The market didn't go any higher from that last reading. In fact, suffered then. That was the biggest correction in some time there. You can see that drop again. You can measure these out. Just take your own chart. I don't have the gains, the losses computed. Now here was a cluster of extreme bullishness. You see all the red lines back to back weekly, a couple weeks in between where the readings abated a little bit down to below those extreme levels. So what happened? So this was a period of extreme bullishness. During really most of those red readings came during the market rally. We did have, after that initial thrust up in a lot of those readings, we did have a sharp drop. It's hard to make it out in there. You can see that I put the candlesticks white. We had some extreme bullishness. The bulls were voracious at this point, but yet another correction. Now they won. I'll give them that. After this correction, there was also, remember, prices came back. Valuations were much more reasonable. Bearishness was ramped up. So a lot of that was a short covering rally. The way I read into this, guys, is I look at this whole cluster of readings here, this whole period, and then it abated. Okay, after that, the market, again, pretty much didn't go anywhere. Yes, it went a little bit higher, slightly higher, but for the most part, from the end of those readings, the market trended sideways for months without making any gains, very little gains, I should say, and then had a virtual crash. This was you can see that drop. That was a huge drop back then. That was the drop in 2015, big drop. Then valuations became reasonable, markets at support, we had a bounce. A single reading, just one. Again, I didn't leave any of these out. We had one reading there that came in between 20 to 27%, and that was it. That was the top. That marked the top in the market. It had an initial sell-off right after that, came right back up to those levels, and then the bottom fell out. And there is, again, one of the biggest drops throughout this entire bear market, or bull market, I'm sorry. Fast forward where we're at today, even throughout this ramp in early 2016, this was the sell-off that occurred right in the beginning of the year. But even after that strong ramp, bullishness didn't hit these extreme levels until just recently. So really we're looking at last week's reading and the reading before. Now the $1 million question is, are we going to see an extended period of where prices continue to rise and bullishness continues to ramp up? It's possible, but again, use this in conjunction with these other charts, because sometimes you just get these single readings like we had here, single reading like you had here with a correction, just a cluster of 2 readings there. So the odds favor getting short now, or being out, or at least being very cautious. If you're long and you're bullish, tighten your stops, because these indicators that I'm going over are not just forecasting little dips or pullbacks in the market. They are used, again, in conjunction with other things, trendline breaks, divergences, the breadth deterioration that we've seen. They help us identify major drops in the market. And right now, a lot of these again, put-call ratio, and this is the sentiment AAII sentiment survey. They are telling us that the market is too bullish right now. Traders are overly bullish, overly optimistic. Okay, to wrap this up, just take a look at some short interest numbers. This is from NASDAQ's website, nasdaq.com. You can go there and take a look, type in, create your own symbol list, follow short interest on stocks. And the trend, what again I look at are trends and extreme levels. So as I go through here, this goes back for last, looks like the last year or so here. You can see the low end of the range is around 50,000. You might briefly dip below there in the high 40s, but 50,000 seems to be the low end of the range, with the upper end of the range on short interest for the Qs being around the low 70s. So really, again, can go anywhere in between there. And where are we at now? And again, it's about trends. We have been consistently from last several reporting periods. Short interest is only reported bi-monthly. Twice a month they report the short interest data, just FYI. So you can see that we've been running at the extreme low ends of the range. We ticked up a little on the November 15th settlement date readings. Next readings will be out in probably another week or so, show it through the end of November. And you can almost certainly, I would say very likely expect a drop again off this level, because short interest and the stock market, where it's going, tends to go hand in hand. We've had that post-election rally ramp, and that more than likely you'll see a lot of that was probably due to short covering. So my expectations, this number will drop. You can also see the short interest ratio, aka days to cover, dropping down and plummeting really recently. So again, these are things that I look at, and they're all aligning right now. It just shows you that sentiment is at or near bullish extremes, where major drops in the market, because you have a lot of bullish traders right now, a lot more bullish traders than bearish traders. Okay, here's Apple. I'm not going to go through them all, guys. You can, again, look at these on your own. Here's Apple. The most recent short interest reading was 44 million, a little over 44 million shares, which, as you can see, going down the line, Apple hasn't had a short interest, that low going back for well over a year now. Short interest has ranged up to 100 million shares in the last couple of years, with the average being here's a 100 million share reading. So I haven't computed it, but you can just take a rough number and say that it's probably in the 60s or more, 60 million shares. So we're at the lowest reading in over a year in Apple. And that just it speaks to the bullishness, or the excessive bullishness in this market right now. Last one, and we'll wrap the video up. This is Alphabet, another big company. You can see short interest right now is under 3 million shares. Again, it's been lower, but it's been persistently low. It ramped up, in the middle of November. But again, you can see the short interest, the days to cover, dropping. Short interest ratio at the low end of its extreme. That's usually where rallies are made of or come from. And going back again, I look at the historical trend going back for the last year or so. You can see a year ago now, Alphabet had over 5.2 million shares short, drop down. But so you can see, again, just glancing these numbers, most are in the 4s or 3s, and we're still in the at the low end of the range. So that's my story, folks. It's pretty consistent across the board. Excessive bullishness, bearish technicals, breadth deterioration in the market, and a lot of other stuff that shows this is probably largely fueled, this rally in the last few weeks here, by short covering. What I think is, again, a lot of traders and investors were caught off guard and are trying to figure out this whole Trump thing, because that wasn't priced into the market. And I think that Trump pump will more than likely be faded soon. Now we're coming up at the end of the year. December is a low volume month. Be careful. Trading's tough. That's always been my toughest period historically, is the month of December, because volumes are low. You get a lot of false breakouts, whipsaw signals. I'll keep the commentary coming, the analysis. Trade ideas will probably be a little on the light side until heading into the end of the year, so we're ready to jump out of the gates in the beginning of the year. However, I will not become complacent, just because December tends to be a relatively muted month. Anything can happen. So I'm watching this market closely. I will continue to post any individual stocks or sectors that stand out. But that's what I'm focused on more so right now, are the individual sectors, the most bullish and bearish sectors out there. Broad market continues to be just a tough animal to trade recently. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.